estate license exams for dummies. Part 5. How much? Validation, financing of real estate. Chapter 16. In this chapter, finding out who collects real estate taxes and why, discovering how to calculate real estate taxes, checking out different kind of taxes exemptions, looking at ways to protect your tax assessment, getting a scoop on tax liens. Chapter 16. It's so taxing, real estate assessment and taxes. The only sure thing in life are death and taxes. I don't know who said that, but it's true. If you own real estate, you'll pay taxes on it. You may pay more or less than someone who owns the same house in a different neighborhood, town, or city. You may have an exemption that reduces your payment or relieves you from payments for a while, or you may not be able to pay your taxes and end up losing your property. People who buy property are concerned about the taxes they pay and will ask you, if they ask nothing else, what the taxes are on the property. Buyers expect agents to know what amount of taxes is due each year on a piece of property. State exam writers expect you to know much more, like why taxes are collected, and how tax rates are established, and how to calculate taxes in a particular piece of property, and how to protest tax assessments that may be unfair. I cover these things and more in this chapter. I define some terms for you to show a little math, but I hope that this chapter doesn't get too taxing for you. Sorry, I couldn't resist. Who wants money, and what do they want it for? Collecting taxes. This morning, you probably drove your car on the street to get to work, right? Call me George Jetson, but personally, I'm still waiting to see flying cars they predicted everyone will be using by now. But assuming you don't have one, you drove your car, and if you're reading this during a school year, your kids probably went to school this morning. Now think about where the water comes from and where the sewage goes. Who gives you the parking ticket last week? Who put out the fire down the street? You and I expect the government to provide these services and facilities, don't we? And it takes money to give everyone what they want, doesn't it? The kind of services that I'm talking about generally are referred to as municipal services and are provided by the town, village, or city, or municipality, and sometimes the county. The primary way that a municipality pays for these services is by collecting taxes on real estate. Why property taxes instead of something like income? Real estate is hard to hide. The value is somewhat predictable. It provides a relative stable way of collecting the money needed for all of those services we want. A word you need to know in connection with taxes is the word levy, and just means the charge against, as in a tax of 1,000 is levied on that property. Taxes on real estate are called varium taxes. The varium taxes based on the value, and it refers to the fact that taxes charged to a property are based on the value of the property. Ad valorem taxes sometimes are called general tax or general real estate tax. In some communities, a single or general tax is levied, and it pays for all municipal services. In other communities where individual taxes districts are set up, a property owner may also pay separate school district taxes as well as taxes for specific services like sewer. These individual taxing districts are generally called assessing units. In some cases, a property owner may pay taxes to several different assessing units, either directly or through the municipality they live in. In some communities, a property owner may have to pay 4 or 5 different taxes in the same piece of property, with each tax designated to pay for a different municipal service. Although the property is not crucial for exam purposes, you may want to see whether your state uses real estate tax revenue to pay for its operations. Most states use sales tax and income taxes. Some states have passed laws to limit the amount of taxes a local municipality can collect, or the amount tax rate, which can increase from year to year. You should check out to see if your state has any laws like this. Recognizing what's so special about assessment. Another kind of tax that's levied against real estate is called special assessment. Special assessments are taxes that are collected against a particular group of properties, rather than against all the properties in the municipality. They are used to pay for infrastructure improvements like sidewalks, drainage projects, and other types of improvements in a particular area of the community. The area of designated properties is called a special assessment district. The town, city, and counties passed an ordinance or laws that create a special assessment district and designates the purpose for which the tax money will be collected. Go figure, calculating taxes step by step. As a tax assessor, a friend of mine observed, if you think you're paying too much in taxes, go down to the hall and complain to the mayor. But if you don't think the assessment on your property is too high, go see the tax assessor. The key element in calculating the property taxes owed on an individual piece of property are its assessed value and the tax rate. In this section, I explain the terms like assessed value and assessed ratio to show you how to do calculations that you need to be able to do for the exam. For extra practice on tax math, see chapter 18. I also discuss equalization rates for figuring out county taxes. A good thing to know for the exam. Also valuable, assessing property for taxes. The word assess really means to assign or to give value to something. The assessed value is not necessarily the actual dollar value of a property. A municipality may, for example, assess property at 50% of its market value. Property value is the price the property would bring in a fair and open sale on the real estate market. Find more about the market value and appraising value in chapter 14. The assessed value is the value of the property that is used for real estate tax purposes. The percentage that is used to calculate and assess the value is called the assessment ratio. To find the assessed value of any given property, you simply use this formula. The market value times the assessment ratio expressed as a decimal equals the assessed value. Say the market value of a property is $200,000. In the community that assessed at 50% of the market value, the assessed value is $100,000. $200,000 market value times 0.5, 50% assessment ratio equals $100,000 assessed value. If you take the same property in a community that is assessed at 70% of market value, the assessed value is $140,000. And if you go to a community that assessed to 100% of the market value, the assessed property is $200,000. To apply this fairly on a purely mechanical and mathematical basis, the key is that each municipality uses the same assessment ratio for all the properties within its jurisdiction. To fully appreciate how this works, you'll need to understand that the taxation of a property is about equity and not about objective value. If you and I own property that has the same market value, we should be paying the same amount in taxes. And because taxes are based on assessed value, the assessed value of each of our properties should be the same. And if our properties have different market values, then the assessed value should be proportionally different, and so should our taxes. I put some numbers to this definition in table 16-1 because calculating the assessed value of a property based on its market value and its assessment ratio is one of the type of calculations you may have to do on a state real estate exam. Table 16-1, property A and B are assessed fairly because each of them are being assessed at the same assessment ratio of 50%. Remember, the assessment ratio is calculated by dividing the assessed value by the market value. For property C to be fairly assessed, you multiply the assessment ratio times the market value. 400,000 times 0.5, 50% equals 200,000 assessed value. As you see, the assessed value to the proportionally fair, it doesn't matter if the market value or the properties are given municipalities as long as it's assessed is called the assessed value is calculated using the same percentage. Going one step further, as you look at the assessed value in the example, because taxes are based on the assessed value, property C will pay twice as much as the property A, and it's fair because property C is worth twice as much as property A. Table 16-1, figuring assessed values. Property A, B, and C. Market value 200,000, 300,000, 400,000. Assessed value 100,000, 150,000, and then a question mark, but which will be 200,000. There are a few places which you read about in your real estate courses where the assessed ratio varies from different classes of property. A class of property, for example, would be residential or commercial. These varied assessment ratios are more likely to be found in larger cities. Find out if your municipalities in your state uses varying assessment ratios for different type of classes of properties. The numbers game, understanding tax rates. Although calculating tax rates probably isn't something you specifically need to know how to do for an exam, it is something you need to understand in general to answer non-math questions about the process. Knowing how to calculate taxes also isn't a bad thing, because you probably pay taxes, property taxes, and may want to know how these guys in the city hall come up with their numbers. Tax rates in a municipality are based on calculations involving a budget, needs in a community, and a total assessed evaluation of the community. The municipality must first arrive at a dollar amount for its annual budget, and after the figure is adopted, the municipality looks at its tax base, which is a total assessed variation of tax property within its community. So how do you figure out a basic tax rate? Easy, just remember the formula. Municipality budget divided by total assessed evaluation equals tax rate. For example, say a city has adopted a budget of 2.5 million. Its total tax base is 50 million. You divide the budget number by the total assessed value to come up with the tax rate. In this case, 2,500,000 divided by 50 million equals $0.05. This formula translates the fact that the municipalities must collect 5 cents for every dollar of its total assessed value. However, tax rates never are expressed in cents, but rather in one of these three ways I discuss next. Throughout the United States, tax rates are reported in one of three different ways and vary by state and municipality within the state. Using the basic tax rate that I calculate in the last paragraph, the 0.05 cents of tax for every $1 of assessed validation is an example of the three ways they are. Mills of taxes, $1 of assessed value. 50 mills divided by $1. 1 mill is 1/10 of 1 penny. So 50 mills is 0.05 cents, which is again divided by the number of mills, usually referred to as the mill rate or millage by 1,000. Dollar rates. It's mileage by 1,000. Dollars of tax per $100 of assessed of $5 divided by 100. Dollars of tax per $1,000 of assessed value. $50 divided by $1,000. Each of these calculations is a different way of expressing the original calculations of 0.05 cents for every dollar. Doing a decimal diddle, calculating the taxes due. Although you may see a few questions on the exam about how taxes work, the math question you're most likely to see on a state licensing exam is one which you must calculate the taxes on a piece of property. The basic mathematical procedure to multiply the assessed value by the tax rate. Assessed value of the property times the tax rate equals taxes due. Because different municipalities and the states may use the three different methods, I show you three problems using mills per dollar and assessed value, dollars of taxes per $100 and assessed, and the dollars of taxes per $1,000 of assessed value. You need to be able to calculate taxes using all three methods. Take note that the tax rates in the examples that follow stay the same. When a tax rate is expressed in mills, tax rates frequently are expressed in mills or as a millage. A tax rate expressed in mills per dollar of valid valuation. As already mentioned, a mill is 1/10 of 1 cent, so 0.001. A tax rate of 5 cents of taxes per dollar of value is equal to 50 mills per dollar. Conversely, and this is more likely conversions you'll have to make, the tax rate of 65 mills is 0.065 per dollar of assessed value. The typical question should be to calculate taxes on the property. If you're given assessed value of the tax rate expressed in mills, to convert to millage rate, sometimes called the mill rate, into something you can use in a calculation, just use the following formula. Millage divided by 1,000 equals mill rate expressed in dollars or cents of tax per dollar of assessed valuation. Suppose a property has an assessed value of $60,000 and a tax rate of 40 mills. The first step is to convert the millage into dollars. There are a couple of ways you can do this. 40 mills divided by 1,000 equals 0.040. While converting the mills to dollars by moving the decimal point 3 spaces to the left, remembering that the decimal is always at the right end of a whole number, even if it isn't actually there. So 40 mills equals 0.040. Now you've done the conversion, you multiply the assessed value in a millage rate expressed in dollars. 60,000 assessed value times 0.04 cents equals 2,400 in taxes. When the tax rate is expressed in dollars per hundredth, again, say that the assessed value of a property is 60,000 and the tax rate is $4 per $100. The tax rate, in other words, is $4 for each $100 of the assessed value, or 0.04 cents. How much are the total taxes? Remember that you find the taxes by due by multiplying the assessed value and the tax rate. The calculation is 60,000 assessed value by $4 divided by 100, the tax rate. The $4 tax rate divided by 100 ratio of the assessed valuation equals 0.04 cents in taxes per $100 of the assessed valuation. So 60,000 assessed validation times 0.04 cents tax rate equals 2,400. The other way to do this by hand or by calculator is 60,000 assessed value divided by 100 equals 600. 600 times $4 equals 2,400. When the tax rate is expressed in dollars per thousand, say the assessed value of a property is 60,000 and the tax rate is $40 per $1,000 of assessed value. What are the taxes on the property? Again, by multiplying the assessed value of the tax rate like this: 60,000 assessed value times $40 divided by 1,000, the tax rate. $40 the tax rate divided by 1,000, the ratio of assessed valuation equals 0.04 cents tax rate per thousand for $1 of assessed valuation. So 60,000 assessed valuation by 4 cents tax rate equals 2,400. Doing this problem with a calculator, you will enter the following equation: 60,000 divided by 1,000 equals 60. 60 times $40 equals $2,400 in taxes. A nice balance using equalization rates. Using equalization rates. You have to do a problem using equalization rates, sometimes called equalization factors, to figure out a county or school district's property taxes. On opposed to the city, town, or village property tax. So I'll explain that there are and how they're used. In a simple situation, several towns, cities, and villages within the county all levy their own taxes to pay for their own services, but this county also needs to collect taxes from all the residents in the county, and it may use the taxes assessed from each of the towns, villages, and cities. The equalization factor are needed in a situation where, assuming assessments from each town or village, equalization factors are needed in a situation where county property taxes are being collected for several different towns, cities, and villages, municipalities that are using different assessment ratios within the county. For example, House A in Town A has a market value of $200,000, and House B in Town B has a market value of $200,000. But Town A uses a 50% assessment ratio. For more about assessment ratios, see Also Valuable Assessing Property for Taxes early in this chapter, which results in a value of $100,000. In Town B, use an assessment ratio of $40,000, which results in an assessed value of $80,000. If you apply the same tax rate to those two assessed values, House A will pay more county taxes than House B, even though they had the same market value. The equalization rate to the rescue. The equalization rate is used to eliminate the difference and make sure people are paying their fair share of county taxes, regardless of the assessment ratio their local municipalities use. Different counties may have the math slightly different, but an easier way to look at it is that the equalization rate compensates for the individual municipal assessment ratios so that each property in the county is brought back to its full market value. The value of its used county tax calculation purposes. You need to note that although equalization rates are commonly used by counties, and that's the example I use, they can be used by the unit of governments to collect taxes from different lower level taxing units, like regional water authorities that tax multiple counties and municipalities. In the case of centralized school districts that encompass several municipalities, the equalization rate compensates for the different municipal assessment ratios. To figure out the county taxes on any given piece of property, you take its assessed value and multiply it by the designated equalization rate to come up with its equalization value. Don't worry, you won't be asked to calculate the equalization rate on the test. You then multiply the property equalized value in a tax rate expressed in one of the three discussed in doing the decimal diddle, calculating the taxes due early in this chapter. And presto, you have the county taxes due. Here are two handy formulas. Total assessed value in a municipality times equalization rate for the county or other taxing units equals the equalized value, or total assessed valuation for the county or other taxing units. Equalized value times tax rate for the county or other taxing units equals taxes due to the county or taxing unit. Want to see equalization rates in action? Say Town A assessed its property at 25% of the market value, Town B at 50% of the market value, and Town C at 80% of the market value. You can read about assessed ratios in Also Valuable Assessing Property for Taxes early in this chapter. When the county applies its tax rate to all properties in the county, properties of the same value would unfairly pay different amount of taxes because each house is assessed at a different percentage of the market value. Remember, taxes are calculated against the assessed value, not market value. A $100,000 house in each of the three example towns, respectively, is assessed at $25,000 to be at $25,000 Town A, $50,000 Town B, and $8,000 in Town C. The simplest thing to do is to raise all the properties back to their full market value and then use the calculation to calculate the taxes. The equalization rate is based on different assessment ratios in each town, so the taxpayer pays their fair share relatively to each other. In the example that follows, all three taxpayers pay the same amount of county taxes because all three houses have the same market value. I've calculated equalization rates for the assessment ratio. I'm using an example to show you how and why it works out. Assessed value times equalization rate equals equalized value. 25,000 times 4 equals 100,000. 50,000 times 2 equals 100,000. 80,000 times 1.25 equals 100,000. Note a few factors. I've equalized the value up to 100% of the market value. It doesn't have to be 100%. It can be equalized to any level of value as long as all individual assessments are equalized in the same manner. The different equalization rates in effect to each of the property. Each municipality assesses the property at a different percentage of the market value. You probably won't have to calculate an equalization rate, but you may have to calculate taxes using the equalization rate. Here's an example problem. Here's a simple problem. The property is assessed at $40,000. Its equalization rate for the county taxes is 1.5. The county tax rate is 10 mils. What is the county taxes on this property? $40,000. The assessed value times 1.5 equalization rate equals 60,000. Equalized value. 10 mils tax rate divided by 1,000 equals 1 cent tax rate per dollar. 60,000 equalized value times the 1 cent county tax rate equals $600 county taxes due. Unfortunately, I've seen cases in which questions about equalization rates seem to indicate a lack of understanding of equalization rates on the part of the question writer. Just in case you get a question that mentions equalization rate, it doesn't specify that it's for a county or school district. Your best bet is to use a simple calculation that uses the section and uses the equalization rate to calculate the taxes due. Home free, sort of. Buying property tax exemptions. Some properties are exempt from paying real estate taxes, and other property owners may actually pay reduced taxes for one reason or another. In this section, I tell you about the most common situations in which tax exemptions and reduced taxes are in effect. All information in this section is subject to state and local laws, so you need to check to see what kind of properties are fully and partially tax exempt in your state and what exemptions are available for certain groups of people. Free ride, fully tax exempt properties. Government-owned properties, or properties owned by federal, state, county, town, city, villages, townships, boroughs, and any other level of government, are tax exempt to the extent that the government don't pay taxes to themselves, nor do they generally pay taxes to a higher or lower level of government within which the property is located, provided that the property is also located within the border of the government that owns it. So a town not only won't usually pay taxes to itself for a town park, it also won't pay real estate taxes for the county for its park that opposite the federal government owns. The state-owned land likewise are exempt from paying local real estate taxes. The one exception to this exemption is where property is owned by one government is located in a completely different governmental jurisdiction. For example, Town A owns a reservoir in Town B. Town A may very likely pay taxes to Town B, but if Town A and B are located in the same county, neither pay county taxes for the reservoir. Likewise, if County A owns property in County B, it probably pays taxes to County B. This may vary by state, so check it out. Okay. Other properties that are fully tax exempt. School districts, water districts, sewer districts. Simply, other properties that are fully tax exempt in general include the following: school districts, water districts, sewer districts, simply public service organizations that own property. Property owned by private educational institutions, religious organizations, hospitals, and charitable groups. Just a small piece. Partial tax exemptions. Different states have different rules and programs that may exempt a portion of a property taxes. You probably won't get a question on the exam about specific exemptions in your state, but you nevertheless need to check them out just in case. A partial exemption works in one of the several ways. It can apply to taxes directly by reducing the amount owed. It can apply to the assessment by reducing the amount owed. It can apply to the assessment of reducing assessment for the individual. Or it can apply by reducing the assessment for the particular class or type of property. Here are a few examples. Partial relief of total taxes that have to be paid may be granted. This partial exemption usually is a percentage of the taxes due and may be offered to senior citizens or the disabled. Income qualifications may also be attached to the exemption. So persons may have to be 65 or older and making less than a certain amount of money to qualify for the exemption. Another type of partial tax exemption is a reduction in assessment on the property. This type of exemption typically is offered to veterans. The exemption may be either a fixed dollar amount or percentage of the assessment. It may vary according to whether the veteran was in combat and or is disabled. Special programs may also provide relief in the form of reduced assessment from various specific taxes such as for schools. Some states also provide different assessment ratios for different types of properties. I discuss assessment ratios and also valuable assessing property for taxes early in this chapter. For example, commercial properties may be assessed at higher assessment ratios than residential properties. And what that means is that if you have a residential and a commercial property that have the same market value, the commercial property pays a higher amount of property taxes than the residential property of equal value. And remember that when you're an agent selling a property, you need to find out the taxes on that property as if no exemptions were applicable. Your buyers may not qualify for the same exemptions as the seller. You can find out the taxes on the property by consulting a municipal or county assessor to get the assessment information and the receiver of the taxes, treasurer or department of finance to get the tax rate. When using the method described earlier and doing the decimal diddle, calculating the taxes due, you can figure out the taxes. That's not right. Protesting assessments. Remember that tax assessments are about fairness, not necessarily objective reality. If your community assesses everyone at 100% of their property value, then you need to be on the lookout for a property being valued at a higher value than it actually is. You can argue that your property is being overassessed because it's really worth what the assessor says it is. This situation is one of the few in which you ever try to make in that argument. The other way assessments can be unfair is when properties in the same community are assessed at different percentages of their market value, also known as assessment ratios. See also valuable assessing property for taxes earlier in this chapter. For instance, if most of the properties in a town are being assessed at 50% of the market value and yours is being assessed at 70% of market value, you have a case. All states have some method or process in place for protesting the assessment on the property. Each state may have a slightly different process. Typically, each community has some sort of review board before which you can protest your assessment, usually during a designated time of the year. And if you're still unsatisfied with the review board's decision, court actions usually are necessary. You may be asked the questions about the process on exam. You may want to find out just how your state handles tax assessments reviews. At the very least, you need to find out what the local tax assessment review board, if one exists, is called in your state, county, or municipality. Before you take your first official step towards protesting assessments, you first need to check out whether records for your local tax assessor has on the property, making sure that the description of the property upon which the assessment is based is accurate. Assessors are reasonable people, and you may find that being assessed for a back porch that the last owner tore down but never reported. Pay or lose, tax liens and sales. You can read all about liens, including tax liens, in Chapter 8, but here are a couple points you specifically must know about tax liens. Individual state laws dictate the details of what happens when real estate taxes go unpaid. You're unlikely to get questions that deal with that level of detail. A number of practices are commonly placed. However, I discussed the ones that you need to be familiar with here. But just in case, you still should check out the details in your home state. If you don't pay your taxes, eventually a tax authority called the city can take legal actions to collect them for you. The first action taken generally is the placement of a lien against the property for the unpaid taxes. A lien is a financial obligation attached to the piece of property. After that, other legal actions may take place that can take one or two forms. Tax sale. One way that the city collects the money you owe in taxes is collecting a tax sale. The city sells the tax debt to someone. The person pays the city what you owe, and if you don't pay the person back, usually includes some kind of interest or penalty. The person can claim ownership of the property. Before and during this action, the property owner has the right to redeem the property by paying the taxes plus the penalties or interest that applies. The right to do this before a tax sale is known as equitable right of redemption. The right to do this after the tax sale is called a statutory right of redemption. The time frames and details of how these redemptions work are governed by individual state laws. You can remember these two terms by the fact that E for equitable is near the front of the alphabet, and equitable rights of redemption goes before sales, and the S for statutory is near the end of the alphabet, and statutory rights is redemption after the sale. Foreclosure. Another way the city can collect unpaid taxes is by foreclosing on the property, which means taking ownership of it and selling it to pay the unpaid taxes. For more about foreclosure, see Chapter 15. In terms associated with foreclosures for unpaid taxes is in rems. In rem means the city takes action against the property rather than against you. Banks that lend money for mortgages are particularly concerned about tax liens because a tax lien takes first priority, which means it must be paid before other liens, including the mortgage. The mortgage lender therefore is concerned that if a property must be sold for unpaid taxes and not enough money will be left for the sale to pay them back the balance owed on the mortgage loan, that the bank, and that's the reason why banks require the homeowners to pay into tax escrow accounts from which the banks pay the taxes, just to be sure they get paid. You can read more about mortgages in Chapter 15. And that was Part 5. You want how much? Validation and financing of real estate. Chapter 16 is taxing, real estate assessment and taxes. Thank you very much.